Welcome to the role of market maker on the FlowTrader platform. Market makers perform two crucial roles for an investment bank. First, they need to provide clear and accurate pricing for their sales traders to communicate to the clients in order for the bank to make commission. Second, they then manage the risk on the bank's books, which has resulted from facilitating the client trade. Let's take a look at the platform and show you how this is done. On the top left, you have the different products that you can trade, and you can see the type, whether they're order driven if they have an O afterwards, or quotes driven if they have a Q. Quote driven markets, when you click on the ticker, the interdealer broker window will populate, and you can decide which broker to buy or sell from if you're looking to trade. Order driven markets, when you click on the ticker, the exchange window will pop higher, and you can probe the market. Remember, the larger the size of the trade, the wider the average price in the exchange that will be received. This is exactly why the hedge funds are calling you to find them better prices. What you can do is try and pre-position yourself as the investment bank so you can give the very best prices and ensure you get the commission. So, for example, recent news here about US Fed hiking rates. If you read that as a market maker, it might be that you thought that the sales trader is about to receive calls asking for long dollar positions. So if you've been quick enough, you can see here I'm trading in a relatively small size, so not to move the exchange price. And now I've managed to build up 2,000 contracts in the Dixie long. So I'm already long. So when that client asks for 2,000 contract order in the dollar index, I can see that in the exchange, this client would have to buy at 119 or sell at 110. That's why they're calling me as an investment bank, to avoid that wide spread. The beauty here is I've already pre-positioned myself long, so I know that the client wants to buy, which means that I can put my offer very, very close to the market price, because if the client buys, I sell, and ultimately that's my aim as an investment bank, to get out of this position of risk. Now, I don't want to buy any more because I'm already long, so the price that I communicate to my sales trader would be 111, which is the same as the exchange, so it's very unlikely that the client is going to sell there, which would make me buy more. So I would say in this case 111, but for the offer, I can give the price that's trading, 115, or now this case 116. So I'd say 111, 116. The sales trader would then send that price over to their client, and if the client then buys at 116, I would sell at 116 and make a decent amount of money on the trade itself, as well as the commission, of course. The good thing here is, with the client buying at 116, they're getting a much better price than the 120 they would get in the market, but it allows me to sell at 116, which is much better than the 111 I would have to get into in the exchange if I unwound this position altogether. So think about the pricing. Pricing will help if you can pre-position yourself effectively. Without pre-positioning yourself, try and get as close to the reference price as possible, but do just bear in mind it's going to perhaps cost a little bit more for you to then unwind that trade at no risk. So pre-positioning will help, but any price that the client asks for, try and go as close to the reference price as possible. Now, how else can you manage your risk? Well, this is for order-driven markets we've been looking at. We also have quotes-driven markets. So let's say if a client asks for a position in gold, I can click on gold. And when I click on gold, I can say, or maybe it's $2,000 here. I can see what they would be getting from the interdealer brokers. And once again, I would like to give a more narrow spread to my client than that. If I now have received a position of risk, so you can see now here, I'm already short in gold, 100 contracts. One way I can manage that risk, and I very much encourage you to do this, is to go to the My Quote board, bottom left. You can click on that My Quote board, and now here you can see I'm short, so I don't want to sell anymore, so I'm going to increase my offer offset away from the market, and I'm going to reduce the negative number of my bids value. So remember, fast and clear prices to your sales trader. Try and go as close to the reference price as possible. That's objective number one. Objective number two is then to unwind the risk on your books. Try and get out of these risk positions so you can make the commission and limit your exposure to adverse market conditions. I hope that's clear. Market makers, good luck.